So we have been discussing many ratios like PE, price to book, debt to equity ratio, many such ratios. But then one important ratio which I always look at before looking into a stock is the working capital or its working capital management. So how to analyze the working capital management? So in my earlier videos as well, I had explained in detail what is the working capital. So quickly revising it, it is just the current assets minus current liabilities. Current in the sense, it is like for the current 1 year. Whatever for the current 1 year, the company is having assets, and if it is more than the current year's liability, then the working capital will be positive because it is assets minus liabilities. So as it is positive, it means that company has enough assets, which is like the current assets include inventories, then the trade receivables. So trade receivables is like the money which is pending from the customer to be paid to them. So current liabilities include the payables, means the company has bought something from his sub vendor and he is yet to pay them. So that is the current payables. If the inventories are building up, so this will increase the current assets, which is not a good sign. But then enough inventory should be there for the dispatch to happen, for the order to be executed. So there should be a balanced value. So hence comes the current ratio, the current asset to current liability ratio. So that should be ideally in the range of 2, not less than 2 or not so much more than 2. So if it is much more than 2, which means that the inventory is building up and it is not being dispatched, so they are not converting that dispatches into cash, because unless and until you sell the inventory, you won't get money. Hence another ratio, cash conversion cycle. So it is the total cycle which is required to convert your finished goods into cash. So you borrow cash or you have cash. With that cash, you bought the raw materials, and with the raw material, you made a product, and that product is stored in inventory, and based on the customer's requirement, it is been dispatched to the customer side, and then he pays you back, so you get cash. So cash to cash. So that's a cash conversion cycle. So how to calculate cash conversion cycle and all, I have already explained you in earlier video, whose link I am leaving you here. So cash conversion cycle, working capital management, current ratio. And also there is something called quick ratio, wherein the inventories are also subtracted from the current assets and some prepaid taxes as well, and it is divided by the current liabilities. So that's quick ratio. So it is more stringent than the current ratio. So current ratio, quick ratio, and if you want one more ratio, then it's cash ratio, wherein the cash and cash equivalence is divided by the current liabilities. So that is even more stringent. So these are ratios to analyze the company's efficiency. So you know that you just cannot go with the profitability of the company, or if he has posted good earnings per share based on the higher PAT. So this may not be a ratio of a good company. So you need to look at the working capital management as well. So for analyzing or evaluating the working efficiency of the company, you have to look at these ratios. So lack of working capital means the company is struggling to have cash to run its business. Because if the working capital is very low, it means that it doesn't have the capital. The word itself tells that working capital, the capital which is required to work or run the operations of the company. So he has to borrow more, then his interest liability increases, so a lot of liabilities increases, and again working capital goes down. So there should be a fair balance in all these things. So all these ratios will help you evaluate the efficient operation of the company. So next time, as a value investor, don't just go with the profits or the revenue recorded by the company. Look at their working capital as well, wherein if they are able to clock some order, but then if they are not able to collect money, then there is no point of running the business, because the company won't have free cash flow in its accounts. So looking at it is also important. See you next video. Till then, happy investing.